If I was going to retire today, I would seek to achieve an optimal mix of yield, growth, and safety. Many investors appear to think that retirees should just focus on maximizing safe income and do not need to worry about growth, but the reality is that most new retirees still have a very long investment horizon ahead of them, often of up to 20 or even 30 years. If you only invest in bonds and treasuries, you will earn a decent income. However, your principal could lose substantial value to inflation in just a decade or two. This is why I think that real estate investment trusts, or REITs in short, are better options for most new retirees who still have a long investment horizon. They provide a competitive yield, but they also protect you against inflation, which is so important in today's environment. Best of all, REITs are today priced at their lowest valuations since the great financial crisis, and as a result, there are many individual REITs that offer you a 6 to 8% dividend yield with low payout ratios in the 70s, and they also enjoy 3 to 5% steady annual dividend growth. Therefore, if I was going to retire today, I would invest very heavily in REITs, and these would be my top 5 choices to achieve an optimal mix of yield, growth, and safety. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and today's video I'm going to talk to you about 5 of my favorite REITs for retirees. You will know that all of these REITs have a strong investment grade rated balance sheet. They own mostly recession resistant properties that generate highly consistent and predictable cash flow, and yet the average yield of these REITs is about 6%, and that's with a low dividend payout ratio of about 70%, and I expect their dividend to grow by roughly 5% annually over the long run. Before I get into the first REIT, can you please do me a huge favor and click the like button? That helps me a lot to produce this content for you. Thank you so much in advance. So the first REIT I'm going to discuss here is a pretty obvious choice. It's NNN-REIT. Its ticker symbol is NNN. This is a REIT that has now managed to grow its dividend for 34 or 35 years in a row. It has an even longer dividend growth track record than its close peer Realty Income. And that really tells you everything you need to know about this REIT. Its business is so resilient that it has managed to keep on growing its dividend even despite the dot-com crash, the great financial crisis, or even the pandemic. And so what is its secret? It's really not rocket science. The REIT is investing in highly resilient properties and it's combining that with a fortress balance sheet. The properties that it's mostly targeting are service-oriented net lease properties such as pharmacies, convenience stores, dollar stores, and so on. Such properties are especially attractive for income-oriented investors and retirees because their leases are typically structured in a way to be very favorable to the landlord. For one, the lease terms are typically very long at over 10 years. Then for two, the leases include automatic annual rent escalations of about 2%. Then the third thing here to consider is that the tenant is typically responsible for all property expenses, including even taxes and insurance and even the property maintenance. And then fourth, typically the rent coverage ratios of these net lease properties is about 3 to 4 times, which means that even if the tenant suffered temporarily in a recession and so its profits dropped down significantly, in most cases it should still be able to easily cover its rent payments. And so NNN-REIT owns a highly diverse portfolio of such net lease properties that are service-oriented, e-commerce resilient, and they are mostly located in rapidly growing Sunbelt markets, and then combines this defensive portfolio with a fortress balance sheet that has a BBB plus investment grade rating and some of the longest debt maturities of the entire REIT sector at 13 years, which protects it from the surge in interest rates. Today, the company is bigger and better diversified than ever. Its balance sheet is the strongest it's ever been. Its payout ratio is historically low. And despite that, it's priced at a historically low valuation of just around 12.5 times FFO, and it's offering a 5.5% dividend yield. The shares are today discounted because the company is facing a temporary slowdown in its growth because its cost of capital has gone up, but the cap rates of the properties targeting have been stagnating. It's taken some time for them to adjust higher, but this is just temporary. Now the cap rates are finally adjusting higher. It's very evident from the latest results of various net lease REITs, including EPRA Realty, Realty Income, Essential Properties Realty Trust, Vichy Properties, and so on. Now cap rates are adjusting higher and allowing REITs like NNN-REIT to return to external growth by raising more capital to buy more properties at a positive spread that will result in growth in their FFO per share. Then on top of that, interest rates are also widely expected to be cut sometime in the near term, and that's just another tailwind for NNN-REIT. And since it's already offering a 5.5% dividend yield, all it needs to achieve is a 4.5% dividend growth rate for the company to achieve a roughly 10% total return. And then you add to that a bit of multiple expansion as interest rates are cut and its growth accelerate. And you could realistically get to 12 to 15% average annual total returns, which is obviously very attractive coming from a blue chip BBB plus investment grade rated REIT. For this reason, I think that NAREIT is one of the best REITs for retirees. Then my second REIT is a bit of a less obvious choice than NAREIT, and I'm gonna here now talk about WP Carry, ticker symbol WPC. I'm saying that it's a less obvious choice because the company just recently cut its dividend, and because of that, it's now hated by most income-oriented investors and especially retirees. But in this particular case, I think it's very important to consider the reasons why the dividend was cut, and it's simply that the REIT decided to exit the office property segment. It spun off most of those assets into a separate REIT, and so naturally it lost a bunch of its cash flow, and it forced the REIT to readjust its dividend also to a lower level. But as a result of this, WP Carry has now become a much higher quality REIT with primarily industrial net lease properties. Well, most of its properties have CPI-based rent adjustments, so it provides good protection against inflation. It has a BBB plus investment grade rating. It will now be able to retain more cash flow for the future. It will have less risk because it doesn't own those weaker assets anymore, and its growth is likely to accelerate going forward. It essentially went from being a diversified net lease REIT with riskier fundamentals and slower growth prospects into becoming a quasi-industrial net lease REIT with now lower risk and faster growth prospects going forward. Therefore, you could objectively say that WP Carry now deserves to trade at a higher valuation multiple. However, because it just cut its dividend, it's currently hated by most investors, and as a result, it's actually priced at a discount relative to where it was just a few years ago. Right now, you can buy shares of WP Carry at just around 12 times FFO and a 6.2% dividend yield, and that's despite even having a low dividend payout ratio of just around 72%. That's very attractive considering that most other industrial REITs are today priced at closer to 20 to 25 times FFO, and obviously WP Carry doesn't deserve to trade quite that high because it's not a pure play industrial REIT, and most of its properties are under long-term net leases, which will prevent it from hiking its rents as fast as it appears like Prologis. But still, could we see it now re-rate at closer to 16 times FFO in the future? I strongly believe so, and that would unlock about 30% upside from here. But the most important thing here for retirees really is that you're getting a safe 6.2% dividend yield that's very well covered with a low payout ratio, and the REIT enjoys strong CPI-based rent adjustments in its leases, which will provide inflation protection over the long run. And so when you add all of this together, you get a great risk to reward going forward. So far we've picked NAREIT as our net lease REIT investment, then we picked WP Carry as our industrial investment, and now we're going to pick Camden Property Trust as our residential REIT investment. In my opinion, Camden probably offers the best risk to reward for retirees in this property sector. That's because it has an A- rated fortress balance sheet. It's large and well diversified with 170 properties. It focuses mostly on the Sunbelt markets, which are growing rapidly. It also owns mostly affordable Class B properties, which are less impacted by the new wave of supply that's hitting the market. And finally, the company has an exceptional track record, having managed to grow its dividend for decades in a row, all while significantly outperforming the rest of the stock market. Despite that, its valuation is today actually closer to the lower end of the apartment REIT peer group, and that's probably because it's heavily exposed to the Sunbelt markets, which are today suffering from oversupply. They are doing quite a bit worse than coastal markets. However, I think that this is just temporary. By now, new construction starts have collapsed to the lowest level since the great financial crisis. They are down about 70 or even 80%. And as a result, already next year, we expect rent growth to strongly accelerate in these rapidly growing Sunbelt markets. Right around the same time, we should also see interest rates come down to lower levels, and I think that the combination of these two factors, the lower interest rates and the accelerating rent growth, should really be a strong catalyst for REIT like Camden, because it's today heavily discounted, trading at a roughly 30% discount to its net asset value, at 13.5 times its FFO, and it's offering a dividend yield of 4%. And I already hear you say that 4% is not enough for retirees, but you need to keep in mind that the dividend yield is only so low because the REIT retains nearly half of its cash flow to reinvest in growth by developing new properties, also buying back shares. It did some of that in the last quarter. And then on top of that, remember that we're here dealing with high quality apartment communities. This is a lower cap rate asset class. The REIT is not using much leverage, and therefore it's natural for the REIT to have quite a bit lower yield, but the faster expected growth makes up for this lower yield. I think that the REIT has about 30 to 40% upside from here, and given that we're talking here about an A- rated apartment REIT, this is really a great risk to reward in my opinion. Hey, before I go into the fourth REIT, I want to let you know that I'm planning to film detailed videos on each of these REITs that I discuss here, they will be much more detailed and even include potentially management interviews. So if you don't want to miss out on that, make sure to subscribe to the channel. Okay, so we have net lease, we have industrial, we have some residential exposure. Now next, I would also want to own some self-storage, and my top pick here is Big Yellow Group. I've mentioned it many times on this channel, but I can't mention it enough because this is one of my largest holdings and one of my favorite REITs to hold for the long run. Self-storage has been the most rewarding property sector over the past 30 years in the US, generating nearly 20% average annual total returns, and that's despite also being the least volatile of all property sectors. Most investors are today buying public storage and extra space storage, which are the leaders in the US. However, I think that Big Yellow Group, which is the leader in the UK, is much better positioned going forward. That's because the American market has become oversupplied. There is now about 10 times more storage space per capita in the US than in the UK. However, Big Yellow is now replicating the same model that was so successful in the US a few decades ago in the UK, and I expect it to keep growing at a rapid pace for another decade or two to come. The concept is still rapidly growing in popularity in the UK, there is not nearly as much supply, and Big Yellow is filling the gap here by developing new properties, earning initial yields of 9 to 10%, which represent very significant spreads over its cost of capital, and that has allowed it to grow its FFO per share and dividend per share by about 10% annually over the past couple decades, and I think that it can keep this going for a long time to come, and yet it's currently priced at 16 times FFO, with roughly 5% dividend yield, which is a historically low valuation for a company that's growing so fast. Historically, it's been often priced closer to 30 times FFO or a 3% dividend yield. That might be a bit excessive in today's higher interest rate world, but I'm very willing to pay the current share price, and this is why I like to highlight this company on this channel. It's one of my favorite REITs to buy in Europe today. And then my fifth choice here, again, is not quite obvious to a lot of investors, but it will be Crown Castle, ticker symbol CCI. I'm saying it's not such an obvious choice for retiree because it's a bit of a similar situation as WP Carey. The company is going through a strategic review at the moment. It's considering to sell some of its assets, to be more specific, its fiber assets. And if it did so, it will likely cause the company's cash flow to drop quite significantly, forcing it to cut its dividend. However, that doesn't really bother me because if they decide to sell their fiber assets, that would only be because they think that this would unlock value for shareholders. There are a few groups of activist investors who own large stakes in Crown Castle that are seeking to unlock value by any means necessary, and they think that selling the fiber assets would achieve that. And so, I think that they know what they're doing. They're investing hundreds of millions into the stock of Crown Castle. They know the company even better than me. If these fiber assets allows the company to refocus on towers, deleverage its balance sheet, and even start pursuing international tower growth, just like its peer American Tower, then I'm all for it. Best of all, today the company's valuation is historically low, so we have great margin of safety here. We're paying just 12.5 times FFO. We have a 6.4% dividend yield, which is near the highest ever for this REIT. And so even if they decided to sell their fiber and let's say they cut the dividend by 20%, that's still a pretty attractive yield for rapidly growing cell tower REIT. And if they decide to retain these fiber assets, the management is confident that they can return to their historic 6 to 8% annual dividend growth already by 2026. So either way, I think that we're gonna do quite well here. The shares of the company are today discounted because there's not much growth happening in 2024 and 2025 due to some consolidation in its leases. I've discussed this in previous videos. And obviously the market doesn't like the strategic review because it's leading to some uncertainty. A lot of income-oriented investors especially don't like it because they know that a dividend cut could be coming, and so they are selling the stock ahead of that. But if you're long-term oriented and can look past this near-term noise, I think that this is a great opportunity because you're getting to invest in this portfolio of cell towers towers at a historically low valuation and you get a high yield that even if it's cut, you'll still earn a pretty attractive dividend yield over the long run. I think that the most likely outcome is that they're going to sell the fiber, they're going to refocus on towers, they're going to deleverage the balance sheet, and with that, eventually the market is going to reward the company with a higher valuation multiple, which could unlock up to 50% upside from here. So these would be 5 of my top choices if I was going to start from scratch and build a new retirement portfolio today. But if you want to access my entire retirement portfolio, you can join High Yield Landlord for a 2-week free trial. It's my REIT newsletter. This is where I share my real money portfolio and all my trade alerts in real time. As I said, there's a 2-week free trial. This is a real free trial in that you won't be charged anything in the first 14 days. You can come in, check out my portfolio. If you don't like the service, you don't see any value in the research, you can cancel anytime the first 14 days and you won't be charged anything. And then finally, once more, if you could please click the like button. That really helps me a lot to grow this channel and produce all this free content for you. Thank you so much in advance. I'll see you at my next one. Bye-bye.